Quick question. Is Eaton Corporation a buy, sell, or hold? Don't guess. Let's calculate. Our DCF model will tell us exactly what Eaton Corporation should be trading at. Here we go. Before diving into the numbers, let's establish the business context. Eaton Corporation operates as a power management company worldwide. The company's Electrical Americas and Electrical Global segment provides electrical components, industrial components, power distribution and assemblies, residential products, single and three-phase power quality and connectivity products, wiring devices, circuit protection products, utility power distribution products, power reliability equipment, and services, as well as hazardous duty electrical equipment, emergency lighting, fire detection, explosion-proof instrumentation, and structural support systems. As an industrials company valued at $145.7 billion, they employ 94.4 thousand people. Now let's analyze the valuation. Alright, here are the numbers. Eaton Corporation is trading at $374.35, but our DCF calculation puts the fair value at $199.66. That's a 46.7% spread, so let's see what's driving this difference. Now let's examine our key assumptions. We're using a weighted regression of historical and Wall Street analyst consensus estimates, which incorporates forward-looking growth expectations from professional researchers. We're projecting 5.6% initial growth for the first 5 years, then tapering down to 4% terminal growth over 10 years total. EBITDA margin assumption, 19.8%. Here's how we calculate the discount rate. Our cost of equity comes to 8.5% using Professor Damodaran's industry beta data, while the cost of debt is 3% after tax benefits. Combined, this gives us a WACC of 8.5%, the rate we use to discount future cash flows in our DCF model. Let's examine the cash flow progression. We project 5.6% growth for 5 years, then taper over 5 years to 4% terminal growth. Each phase reflects different stages of the company's development. Here's where it all comes together. Our DCF model gives us an enterprise value of $89 billion. The terminal value represents 67% of this total. After adjusting $9.3 billion in net debt, we get $79.7 billion in equity value, which translates to $199.66 per share. The model assumes 4% terminal growth with 8.5% discount rate. Here's where it gets interesting, sensitivity analysis. Our $199.66 valuation depends heavily on the 5.6% growth rate and 8.5% discount rate. What if these assumptions were wrong? Visit Stockoscope.com to test different scenarios and see how the valuation changes. From growth assumptions to final valuation, we've built a DCF model for Eaton Corporation. The beauty of DCF is that you can apply this same methodology to any stock. Check out Stockoscope.com to analyze other companies and refine your valuation skills. Subscribe for daily stock analyses and like this video to support educational content.